into, first of all, I hope you had a nice break and enjoyed your time just to hopefully clear your mind and relax. I know you're probably very busy with catching up with work, with school and your own work and stuff, but hopefully you had 2 minutes for yourself. And I know these last 2 weeks for us veterans here at Penn State are kind of brutal because we get that whole week off and then we're back here for 2. But we'll trudge through. Our plan of action is to conquer chapter 8 between today and Thursday. And then we go to chapter 13, which is on retirements. Specifically, we really focus on the individual retirement account and just some background about retirements, just if you weren't aware of the different kinds there are, and you know, what happens when we contribute to them, what happens when we get disbursements from them. So that's our focus for chapter 13. But chapter 8 brings us back to calculating taxes and then talking about additional taxes that are out there. 1 or 2 we've already talked about, so we'll just briefly remind you about them. And then tax credits, which is a brand new part of our education so far on taxes. So we might have had one, the child tax credit. We're going to talk about some other, probably about 4 or 5 other common tax credits that are available for taxpayers. And that'll be our chapter 8. Okay, so I'm going to get rolling. Are there any questions before I get started? Hopefully you're rolling along with your group projects. I know I modify it from what it's originally given as. So I had to go in the tax software today and do the entire project. So I have an answer key. So if you have any kind of questions, it's fresh in my mind. So just let me know. You can email me or ask now. That's fine. So, chapter 8. I'm going to grab this PowerPoint and share it with you. Okay, so you should see the chapter 8 PowerPoint. So again, we're going to look at determining, just to refresh our memories about how do we determine a regular tax liability. We're going to kick it up a notch with preferential tax rates in there and stuff, just to practice that one more time. We're going to talk about what's called an alternative minimum tax liability, which is really a lie, okay? Because a lot of people say, oh, it's an alternative minimum tax I can pay. No, it's actually a maximum tax. But we'll talk about that. Your net investment income tax, which is a tax for high income taxpayers on investments. Self-employment tax, we've already talked about that. We'll briefly review it. We're also going to talk about something called the Kiddie tax, which is a special tax computation for children who meet certain qualifications. And then we'll get into these tax credits, the child tax credit, something called child and dependent care credit, then our education credits, American Opportunity, Lifetime Learning, and then a special refundable credit called Earned Income Credit. And then finally, the last part of our chapter focuses on what happens if you don't file your tax return? What kind of penalties are there? What if you don't pay your taxes on time? What kind of penalties do we have there? So we'll talk about those a little bit. Some of them have been ignored, I guess you can say, from the CARES Act. And so you want to make sure you read through that, but that's where it primarily affects is late payments because of the whole situation this year. There's a lot of relief out there. They're not going to penalize like they usually do for late payments. Okay, so first off, again, our regular tax computation is dependent on your filing status and our tax rate schedule. Now, if your taxable income is less than $100,000, taxable income, you should use the tax tables. And I'm just going, I know I already went in there, but let me grab the tax tables so you can see, and I'll share this with you. I'm going to the IRS's website and I'll share that. So you should see the IRS's website, and they're in the 1040 instruction booklet. Your tax software will automatically calculate these, but if you're doing a tax return by hand, which usually doesn't happen anymore, but if you do, the very end, come on, don't make a liar out of me. There they are. Okay, these aren't in your book, I don't believe. That's a different one. There we go. Are the tax tables. So you can see the different dollar amounts there. So they start, of course, these are the 2019 tax tables because this is the 2019 instruction booklet. They're set up by, the first column says at least, but less than. So if your taxable income is at least the amount in the first column, but less than the amount in the second column, you're single, you'll use this column for your tax, married filing joint, married filing separately, and head of household. Married filing jointly, that's also qualifying widow or widower, uses that column. So these tables are out there and they want you to use them unless your taxable income is more than $100,000. So you can see here these, I know I'm flying through them quickly, but the big numbers are your taxable income. So they have the table set up, but once you reach 99,000, there we go. There's the 100,000 up there. It tells you if it's 100,000 or over, use the tax computation worksheet. For us, that means the tax rate schedule. So that's what they're referring to in our PowerPoint. And I'll share that back over where it says the tax tables. As I said, usually software knows those tables. They're already within the software and it's going to use it anyway, or calculate the tax. What's really important, and when I was first doing taxes years and years and years ago, we used software, but it wasn't PC based. So we had a computer system at our accounting firm, but we would actually fill out these input sheets as accountants and hand them to our computer operator, and she would manually enter the information into the software and then print out the tax return for us. It was a lot of fun, let me tell you, doing it that way. If you made a mistake, you're like, oh my God, I made a mistake, and now I gotta go and resubmit this input. So when I started doing this, I had to manually do the tax return actually on 2 column sheets, just blank paper. I would do a tax return and then I would put it on the input sheets. And then when I got the tax return back, I would say, well, here's how I figured it out manually. And here's what the tax return came back as. Who's right? So to me, you should still make sure your software is calculating information correctly. So that's why it's really important. We still need to know, how the heck did the software do what it did? Okay, and that's what we're going to show you now. You know how to calculate using the tax tables and the tax rate schedules at the end of the chapter. So there's our tax brackets again, 10%, 12, 22, 24, 32, 35, and 37. Don't worry about this penalty. Here's where we want to focus. If you have long-term capital gains, remember, your tax on those may be at 0%, 15%, or 20%. Okay. If you are on qualified dividends, again, 0, 15, or 20%. Now, where do we determine what percentage we should use? Well, it's based on our taxable income And if you go back into chapter 7, where are you? It is on page 4, 5, 6, 7, 7 in our capital gains area. Come on, page 7-10. And this is where our preferential rates kick in at these various taxable income amounts. What we have to be careful of is that sometimes our long-term capital gains and qualified dividends may be taxed at more than one of these rates, depending where our taxable income ends up as we add these. So we need to see an example of this. Take a look. Now, I'm just going to keep my hand in page 7-10. I'm going to go back to my appendix D, which were your tax rate schedules, so we could see where these numbers are coming from. Assume Courtney's taxable income is $479,050, including $15,000 of qualifying dividends taxed at preferential rates. What would be Courtney's tax liability under these circumstances? Well, they don't tell us Courtney's filing status. We need to know that, right? So it looks like she's head of household from our answer. So we needed to know that. But we would go to head of household, Schedule Z. Now her taxable income is $479,050, but subtract $15,000 because they will be taxed at preferential rates. So we're going to figure out the tax on $464,050 using that tax rate in Appendix D. Her income is taxable income is between $207,350 and $518,400. So we'll take $45,926 plus 35%, her taxable income, $464,050, is above the $207,350. So subtract these two, multiply it by 35%. That is added to the $45,926, tax at ordinary rate. So the tax on this $464,050 is $135,771. Now, let's figure out the tax on the $15,000. If we go over to page 710, head of household column. If your taxable income is between 0 and $53,600, your preferential tax rate is 0. If it's between $53,601 and $469,050, which she's very close to, 15%. Now here's where you have to be careful. Her taxable income right now is at $464,050, right? Come on. The part of her gain taxed at preferential rates that will get her to $469,050 is taxed, $5,000 is taxed at 15%. So that's, an additional $5,000 of taxable income gets her to the $469,050, the last dollar that could be taxed at 15%. Once her taxable income, including that gain that's taxed at preferential rates, goes above $469,050, the remaining portion is taxed at 20%. So that's what we mean. When you have a preferential item, it may not be taxed at that one rate. It all depends where your taxable income is at. If your gain causes your taxable income to go from one preferential rate to another, part of the gain is taxed at that first preferential rate, and the remaining part is taxed at that other which in this case would be the 15% and the 20%. So her total tax on that 15,000, $2,750. So be careful of that. Add the tax on at ordinary rates to the preferential tax to get the total tax. Are there any questions? Okay. And that's what I just explained. Okay, so that's the preferential rates. Let's see if we have anything else I want to talk about there. Okay, that's chapter 7. Okay, let's go to the kiddie tax. I always remember this one because when I was in college in my senior year, I was doing an internship at the company I worked for 6 years after I graduated. And my tax teacher came in on weekends and helped them with tax returns. And I did a tax return for a child of a family that had kiddie tax, and he did the tax return of the other child who had kiddie tax. He did his wrong. And my bosses said, Lori did hers right. Jack, you did yours wrong. And I always remember that. But what is the kiddie tax? Well, people try to shift income from themselves to their children to get a lower tax rate. And they'll even shift, they'll say, oh, I don't care. I'll shift the entire asset to my kid just so that they put, because remember the fruit and the tree concept, remember that metaphor? The fruit follows the tree. So whoever owns the property puts the income on their tax return. So parents will say, oh, the hell with it. I'll just put the asset in my kid's name, the investment, and they'll still pay the tax on it. Nope, you can't even do that. So you could put the asset in your kid's name, okay? And they could earn income off of it. If their net unearned income, unearned, so income that is not from a job, things like interest, dividends, capital gains, okay. So income that they did not have to go out and earn. If it is less than $2,200, okay, regular tax. But if that unearned income is above $2,200 that's in the kids' names, the amount above it is taxed at the parent's marginal tax rate. So if that parent is in a 32% tax bracket, the kid's unearned income above $2,200, the tax on it will be 32%. So there's no getting around it, even if you put the asset in the kid's name. So who are the kids? Who are we talking about here? What is a kid? The kid's under 18 at the end of the year. The child is 18 at year end, has earned income, but that earned income is not greater than half of their support. So they just have a little part-time job. The child is over 18, but under 24, is a full-time student, and the child's earned income is not greater than half of the child's support. So if they fall into any of those categories and their unearned income, unearned is more than $2,200, we have a kiddie tax. Sorry, didn't mean to do that. Okay, let's take a look. Suppose during 2020, Duran received $5,200 of interest from an IBM bond, and he received another $2,100 in interest from a money market that his parents have been contributing to over the years. What is Duran's taxable income and tax liability? the marginal tax rate of the parent is 24%. So let's say, because now I don't think they told us this, but the assumption here is Duran is younger than 18. And his unearned income exceeds $2,200. He is potentially subject to the Kiddie tax. Here's how we figure it out. What is the child's AGI? $7,300. And it's all unearned income. Now remember, no matter if you have earned income or not, if you are claimed as a dependent on someone's tax return, your standard deduction is the greater of, the greater of earned income plus $350 or $1,100. We learned that back in chapter 4. Duran here has no earned income, so his minimum standard deduction is $1,100. So his taxable income is $6,200. Okay. His gross unearned income minus $2,200. So $7,300 minus $2,200 or $5,100. Take the lesser of, in the next step, unearned income, $7,300, taxable income, the lesser of taxable income, $6,200, or what we just computed, unearned income, $5,100. The $5,100 is taxed at 24%. So the amount of unearned income above 2,200, his unearned income was 7,300 minus 2,200, give him that 5,100 times 24%, Courtney's marginal tax rate, that's how much tax is on that first, let me go back here, $5,100 of the $6,200 in taxable income. The other $1,100 is taxed at Duran's normal tax rate. Because his taxable income is only at $6,200 and $5,100 has already been taxed, the other $1,100 will be taxed at 10%. So Duran's total tax liability will be the Kiddie tax plus the tax on the $1,100 or $1,334. That is how the Kiddie tax works. If you go to page 8-7, we're going to do one more. It's Duran, but with a different scenario. If his only source of income is qualified dividends of $5,200, what are his taxable income and tax liability? Now he has qualified dividends. I'm not looking at this slide. I'm looking on page 8-7. Remember, qualified dividends are taxed at preferential rates. In our last example, it was all interest, which is taxed at ordinary rates. So let's see how this changes up because of the type of income it is. First of all, it's unearned and it's all qualified dividends. So $5,200 is his gross income and AGI. His standard deduction, the greater of earned income plus $350 or $1,100 will be the $1,100. So his taxable income is $4,100. His gross unearned income minus $2,200. So $5,200 minus $2,200 is $3,000. So we will tax the lesser of actual taxable income or that $3,000. Well, the $3,000 is lower. In example 8.3, which we're not going to go through all of example 8.3, but Courtney's The mother, her preferential tax rate was 15%. So whatever the parent's tax rate is on that income, marginal tax rate or preferential rate, the kid will use also. So that $3,000 of qualified dividends is taxed at 15% only. Okay, so be careful of that. It's just not automatically at whatever the ordinary rate is. If that income is normally taxed at ordinary rates, yes. But if it's taxed at preferential rates, what's the parent's preferential rate? Use that. Okay. What about that remaining $1,100 of taxable income? Well, it doesn't get taxed because Duran's preferential tax rate is 0 because he has no, his taxable income is not above the limits for anything higher. So the total tax, because it's a qualified dividend, will only be $450. Are there any questions on that? They've been going back and forth, changing this thing up over the last couple of years. They had it one way for a long time, then they changed it. Now they have it back. So we'll see if it changes again. But for now, that's the way we calculate that. And you will see it. I have seen it in Wilkes-Barre, okay? People put stuff in their kids' names to get it out of theirs to try to bring the tax rate down. They do a little bit, but not a lot. Okay. Net investment income tax is an additional tax imposed, and this is after alternative minimum tax, I think. Yes, it's on page 813. I'm kind of hopped back and forth here, but it is on page 8-13. And it's an additional tax imposed on investment income on higher income individuals. So if your modified adjusted gross income is over 250,000 married filing joint, 125 married filing separately, and 200,000. Take the amount above that, compare it to your net investment income, and it's the lesser of the two you'll pick. So your net investment income will be interest, dividends, annuities, rents, passive activity income, gains from disposing of property. So those are all your investment income items. Get that amount. Determine the amount your AGI, your modified AGI, is above those thresholds for your filing status. The lesser of those two amounts will be taxed at an additional 3.8%. Whoops, I kind of threw that one in there. Oh, I thought I had an example here. Sorry about that. So before we go on to the next fun part, page 8-13. Courtney's AGI and modified AGI. And by the way, let's make sure we know what modified AGI is here. Modified adjusted gross income equals AGI increased by income excluded for foreign earned income exclusion. Okay, so if you deducted any foreign earned income to get to AGI, you have to add it back. That is modified AGI for these purposes. And if you're like, that's another definition for modified AGI. Yep. Okay, so modified AGI does not mean the same thing for everything. So you got to be careful of that. So we have Courtney, her modified AGI and AGI are the same. Her investment income consists of $321 of taxable interest, $700 of dividends, and $5,000 of rental income. How much net investment income tax will Courtney owe? Well, her modified AGI is less than $200,000. Okay, because remember, it's the excess. Well, it isn't above, it's negative. So the lesser is negative. There is no additional tax. In the second example, what if her modified and AGI is 225? Okay, now compare her total net investment income to the amount her modified AGI is above 200,000. So her net investment income is $6,021. The excess is 25,000. So the lower of these two, so the 6,021 is multiplied by 3.8% and is considered an additional tax. Now, where will that go? Great question. Let's see. So that's how it works. Let me go to, let me see if I go this way. Oh, no. Okay, I'll just do the 1040 and then I'll, oh my gosh, is this the 2020? Nope. Darn. I got excited there for a second. I thought our 2020 1040 was out. Probably one of these taxes in here, like line 8. That's what I'm guessing. Okay, so these additional taxes are usually reported on Schedule 2, so I'm guessing it'll be on line 8. Might have to file an additional form, and that's where your net investment tax goes. And while we're here, we're going to be talking about this next tax, alternative minimum tax. We've already talked about self-employment tax. Okay. These other things are unique. Okay, but any additional taxes like self-employment, alternative minimum tax are first reported on the Schedule 2. Then they transfer on over to the 1040. Okay, so I'm going to go back to my slides and oh, come on, you current slide. Share that. Okay, there it is. Alternative minimum tax. Now, alternative minimum tax is an additional tax. It was created in 1986 to make sure higher income taxpayers who were able to take advantage of tax deductions and tax breaks paid their fair share of taxes. I've seen people have this calculated. And usually our software does it for us now and lets us know, hey, your taxpayer here, they owe an additional amount of tax because their minimum tax is actually higher than the tax you computed for their regular 1040 tax return. So when we say minimum tax, when we do this calculation, if the calculation is higher than the normal tax we calculated for the tax return, they pay the extra amount from their normal tax to this calculation as alternative minimum tax. A lot of people don't qualify for this. Their regular tax computation is what they pay. If you do this computation and it's less than the person's regular tax, too bad. Okay, it's only when it's more than, then the taxpayer has to pay that excess amount to this computation. Now, I remember learning this and my teacher saying to me, it's like a parallel system you have to do. And I went, oh my God, this was hard enough. Now you want me to learn a whole new parallel system? It's just an extra system or an extra computation. I don't like thinking of it as a parallel system. It's extra. You still do a person's tax return as you always do, okay? But if a taxpayer has been able to take advantage of certain items, either being not taxed or they were able to deduct more than usual, then these items are added back or subtracted. Now, here is how we compute this. We do use a form, it's called a 6251, and we're not going through the form itself. I'm going to show you this computation, but it does follow the form. What we do is we take the taxable income of the individual, taxable income off of their 1040. And we put it on the 6251. And then we add. If the person took the standard deduction on their 1040, we add it back. If they didn't do the standard deduction, we just let that go. That's zero then, because they deducted itemized deductions. Now, what kind of items are added back or subtracted? And that's where we have these things called other adjustments. If you took the standard deduction, you add it back as if you never took it. If you itemized, bottom of page 88, you are allowed to still subtract your charitable contributions, your home mortgage interest, and your gambling losses. All other itemized deductions are added back, except for medical, okay? But if you deducted, if you were able to deduct medical expenses as an itemized deduction, remember only the amount above 7.5%, you've got to recompute that. For alternative minimum tax, only the amount above 10% is allowed to be deducted. Okay, so if you deducted an amount normally, okay, that wouldn't have been deducted if you use the 10% threshold, you have to add that amount back. You have to add all your taxes back that you took as an itemized deduction. Doesn't mean you don't have them. You still take them on your regular tax return. It's just for purposes of computing this, we add them back. You're not allowed to take them for alternative minimum tax calculation. What other kind of things are added and subtracted? Top of page 89. Know those tax exempt interests? Well, if your tax exempt interest is from a private activity bond, and it will tell you on your 1099 INT, if your tax exempt interest is from a private activity bond, for alternative minimum tax purposes, it's taxed. So you have to add that. Real and personal property taxes, I said that, state or income or sales tax, they're all added back. Certain types of depreciation, we're not going to get into it. Okay. If you included any state refund on your 1040 as a taxable item, subtract it. It's not included for AMT. Okay, so there's other items there that are very unique. These are just some of the common, what we call adjustments. And what these adjustments are doing are redefining our taxable income to see, should we be paying more tax? Because we got some pretty nice tax breaks. Once we add and subtract those adjustments, we get alternative minimum taxable income. Now we're not done. We could subtract from that a tax base, or a tax exemption, I'm sorry, a tax exemption. And that tax exemption is on page 8-11. and these do phase out. So if you're married filing joint, your exemption, so the amount you can deduct here is $113,400. But if your alternative minimum taxable income is 1 million, oh, I wish it would be this, 1,036,800 for married filing joint, that exemption starts to phase out until you reach 1,490,400. So it's all based on this alternative minimum taxable income. And then you see the other phase out levels for married filing separately, head of household, and single. So if your alternative minimum taxable income is below the bottom end of your phase out range, you get that full exemption. Subtract it from alternative minimum taxable income, and that is your tax base. So that's what you're going to calculate alternative or tentative minimum tax on. Now, what is the calculation? Page A12. 26% is the tax rate on the first $197,900 for all taxpayers. Other than married filing separately, they have their own. 28% is used for the tax base above $197,900. However, if you have long-term gains and preferential dividends, they are taxed at their preferential rates as they were before. Now, that gives us the tentative minimum tax. We compare that to our regular tax. If our regular tax is more than tentative minimum tax, we're done. We don't have to file that form 6251. But if the tentative minimum tax is above our regular tax, the difference is added to our tax return as alternative minimum tax on that Schedule 2. Nice, huh? Just when you thought you got some tax breaks. So that is the formula. We're going to go through an example or two. Okay, explain that. Okay, we talked about that. So again, items that are commonly added back. If you have tax exempt interest from a private activity bond, if you itemize deductions, all of your state and local income taxes and real property taxes are added back. You're not allowed to deduct those for AMT, for alternative minimum tax computation. There's your phase outs, or there's your exemptions, I'm sorry, and these phase out 25 cents for every dollar over the threshold. So let's take a look before we go into FICA. I'm not going to spend too much time on that, but 812, go through these various, further back. Oh yeah, go through the examples with you. So you, hopefully if I walk you through them, you'll feel more comfortable with it. So I'm going right to page 8-9. So I guess at some point, Courtney's working on her AMT, alternative minimum tax calculation, by determining her other adjustments she makes. Her taxable income is $145,070. Now, some of these, they're telling you where these numbers are coming from for our Courtney example, because she's been used throughout our chapters. But back in chapter 5, Courtney had tax exempt interest from a Cincinnati bond that was considered a private activity bond. It's still non-taxable for regular income tax computations, but for AMT, alternative minimum tax computation, that needs to be added. Her itemized deductions that were allowed in Chapter 6 for state taxes must be added back. So the assumption here is that she was itemizing. And she had a state income tax refund, which was included in her taxable income of $145,070. Well, for AMT, we subtracted. So her alternative, let me go back to this little formula here. Come on. Her alternative minimum taxable income, here's where we're at right now, is $155,150. So that's the first step. Take regular taxable income and do those adjustments. Now, what kind of exemption can she get? Well, since her alternative minimum taxable income, AMTI, is less than the lower end of the threshold on page 811, 518,400, she can take the full exemption of $72,900. Okay, so 82,250 is her AMT base. Now, they just modify the example in the next item. It says, well, what if her AMTI right here, her alternative minimum taxable income ended up being 700,000? Ooh, now her AMTI is above the lower end of the threshold of 518,400. So by how much? Well, take the 700,000 minus the lower end of the threshold, 518,400. Her alternative minimum taxable income is $181,600 above the lower end of the threshold. Well, for every dollar above the threshold, it phases out 25 cents. So multiply that by 0.25. So of the 72,900 normal exemption, she must reduce that by $45,400. So she gets an exemption here, but it's only $27,500. So her AMT base would be $672,500. So that's how that phase out works. The next page. Example 8.7. We're going back to, oh no, Courtney got to take the full exemption. Okay. So her tax base for AMT is $82,250. Now they tell us $700 of that AMT base are subject to a 15% preferential rate. So that means the difference, or $81,550, will use the AMT rates, which say if your tax base is less than $197,900, multiply the tax base by 26%. So 26% of $81,550, $21,203. In number 3, that's the tax on her dividends, $105. So the tentative minimum tax is $21,308. Right there. Now, after all that work, her regular tax is $27,392. So guess what? We did all this computation and it doesn't matter. There is no additional tax because her regular tax was more. Let's say instead that tentative minimum tax came out to be $30,000. Well, now we would take the $30,000 alternative or tentative minimum tax, subtract her regular tax of $27,392, and add an additional alternative minimum tax on Schedule 2, $2,608. Okay, so again, first start with taxable income where it stands now, adjust it to get your alternative minimum taxable income, determine and subtract the exemption you're allowed for AMT. That's your tax base. Once you subtract that, based on your tax base, determine the rate and calculate tentative minimum tax. If it's higher than regular tax, the difference is considered an alternative minimum tax that's added to Schedule 2. It's if the tentative minimum tax is less than regular tax, you don't do anything. Person just pays their regular tax. So that is alternative minimum tax. Questions? Crazy, huh? That's how that works. And there's the 6251 on page 8-10, and it goes through all, that table we just looked is basically how the form is set up, but the form has every specific different type of adjustment. And a lot of this you'll learn if you, when you're in practice. I mean, we just give you a flavor for it. Okay. Employment and FICA taxes, we've talked about this already. The only thing I want to bring to your attention, and you will see this, is bullet point 3, multiple employers during the year. We talked about self-employment. I'm not getting into that. We are, okay, we'll probably come back and look at that one. Let me go into my Word document and Word document, where are you? Okay, let me share a new one. Okay, doing a quick example. Sometimes a person may have more than one employer during a year. Oh, come on. Let's see if I can share this. Finally, there we go. Okay. So let's say you have this scenario. Taxpayer A works at a company from January to August, earning $100,000 of gross pay. FICA and Medicare. So Social Security and Medicare that were withheld, they're less than the threshold, which is $137,700 for 2020. So remember, when it comes to Social Security, doesn't apply to Medicare, but Social Security, you're only taxed on the first, in 2020, $137,700 of gross pay in 2020. And that's taxed at 6.2%. Medicare, there is no limit. Since your gross pay for the first 8 months of the year here, taxpayer A, is less than a $137,700, you will be taxed at 7.65%. 6.2% for Social Security and 1.45 for Medicare. So let me just write that. So it's those two numbers made up. So this person on the first 8 months paid in $7,650 for his total Social Security. Taxpayer A works at company Z from September to December of 2020, earning $50,000 of gross pay. Now, when you leave one job during the year and go to another job, you don't take your paycheck with you from your old job going, look, I already made $100,000 at this other place. All right. So you don't want to be taking all this money out if I go above 137,700. No. When you go to a new employer, you reset to zero. It's like you didn't work at all that year because you didn't work at that company. Okay. So from September to December, you are going to be paying 7.65% because you did not make $137,700 yet at your new employer. So $3,825. So you paid in a total of $76.50 plus $38.25, or $11,475 for Social Security and Medicare because you switched jobs. Let's do this computation. What if taxpayer A worked at company A all year and made $150,000? So now they stayed at one employer the entire year instead of switching. Both situations made $150,000. But because he stayed at company A the entire year, company A will only tax the first $137,700 for Social Security, 6.2%, because that's the cutoff. Or $8,537.40. The $150,000 will be used to calculate the Medicare because there is no limit for that calculation. So $2,175. So if they worked at company A, instead of switching jobs, the total Social Security and Medicare they would have paid on that same $150,000 would have been $10,712.40. Well, that's not fair. Because you switched jobs, you paid more money. That happens. That's the way the system is set up. But relax and don't freak out, taxpayer A. What we do is we request the excess Social Security paid as a refund. So the amount paid minus the amount that should have been paid. Okay, so how much was paid in total? $11,475. How much should have been paid? $10,712. That difference, $763. We requested as a refund on the tax return. And if you look at it, if you take 50,000 minus 37,700 times 0.062, that's the $763. Because that extra amount above 37,700 was taxed, was taxed because of the way they worked during the year. So let me show you where that is requested at. I'm going to grab the IRS form again. I think it's on schedule. Yes. See line 11 here? Under other payments and refundable credits. So we're going to have our tax credits on this form. And this is where we're going to report how much we paid with our, if we made estimated payments during the year to the government. Any excess Social Security tax withheld goes on line 11. And it's treated like you paid that in towards paying your taxes. So what it'll do is that excess will be refunded to you. So you do get it back. You just have to wait till you do your tax return. Okay, so let me run back over to my PowerPoint. Okay. So that is what they mean right here where it says multiple employers during the year. Doesn't always happen, but if your gross pay from all your jobs during the year is more than that threshold of 137,700, you probably paid in too much for Social Security that year. Now, let's talk 2 seconds about self-employment tax. We've already talked about this, but remember, a self-employed person must pay their Social Security and Medicare tax just like everybody else. We call it self-employment tax, and they are subject to that same threshold. The question becomes, what if somebody works and is self-employed? How do they calculate their self-employment tax? So take a look. Assume Courtney received $100,000 of compensation from EWD in 2020. So she paid Social Security tax and Medicare tax on that $100,000 of compensation from her employer. She's also self-employed and she has $180,000 of profit from her self-employment. Remember, usually all of that is subject to self-employment taxes. How will she figure out her self-employment tax? Well, here's how we do it. We say, okay, what's the Social Security base? How much is the maximum gross pay plus profits from self-employment we could assess self-employment tax on, or the Social Security portion of self-employment tax? That's $137,700. All right. Well, she's already been taxed on $100,000 of gross pay. So only $37,700 more, or that part of her self-employment income, can be used to calculate the Social Security portion of her self-employment tax. What are her net earnings that are subject to self-employment tax in total? Profit times 92.35%. That's the percentage they give us. There's a reason for it. We're not going to get into it. Okay, take the lower of these two amounts and you will use the lower of those two to calculate just the Social Security portion of self-employment. So 37,700 times 12.4%. All of her net earnings from self-employment, the 166,230, have Medicare tax because there is no threshold. So take that number times 2.9%. So the 4675, the Social Security portion of self-employment plus the Medicare tax portion added together will be her self-employment tax. Okay, or 94.96. Now, because there's one more thing that we didn't talk about. People are also assessed an additional Medicare tax if their earnings reach a certain threshold. This is another extra tax. Yes, we got to pay for Medicare. So what we do is we take her earnings So that's where the 100,000 comes from, the earnings from her job plus step 2, the self-employment income. So add together the taxpayer's compensation and net earnings from self-employment. If that amount, those two added together, and depending on the filing status, for her, it's 200,000. If it's more than 200,000, the excess has an additional Medicare tax of 0.9%. So multiply that by 0.9. Okay. If she had any excess additional Medicare tax taken out of her pay by her job, which she didn't, but if she did, she would subtract that amount, and that would be the additional Medicare tax she would add to her self-employment tax. So what's our total self-employment tax? Go back here. It'll be the $46.75 plus the $48.21 plus this additional Medicare tax, or $10,092. Okay, so when it comes to calculating self-employment taxes, if the person who owns the business also worked at a job, be careful on how, we don't want to assess them too much in tax or too little. If they make more than the threshold, which, let's see where I find those threshold amounts. I think it's the same as the net investment tax. Yeah, that's on page 8-18. So it's 200,000 for single or head of household. So if your compensation plus self-employment income is above 200,000 as a single or head of household, you're paying tax on that excess. 0.9%. It's 125 for married filing joint, and 250,000 is the threshold for married filing joint. Whew. Questions? Getting too heavy for this time of the day, right? Sometimes there's this area, and it's important, okay, but I'm just going to kind of scroll over it quickly about are you an employee or are you an independent contractor? And this is probably a great place for us to end. A lot of times I have people come into me and they go, I'm an employee and they gave me a 1099 miscellaneous. And I'm like, oh, you're not an employee then. They're like, yeah, I am. I work there, but they gave me a 1099. What does that mean? It says it means they did not withhold any taxes out of the money they gave you. You are responsible for not only making sure all your income taxes get paid, but now you're going to pay self-employment tax at twice the rate you would have if you were an employee. So if you're truly an employee, you tell them you want a W-2. Now, why do companies do this? To get out of paying taxes. They'll say you're an independent contractor so that they don't have to match your FICA and they don't have to pay unemployment taxes on you. And they're not assessed any kind of unemployment against them when they let you go. But it's up to the employer to prove you're an independent contractor. And some primary questions are listed on page 8-21. So if the IRS comes in, and there's actually 20 factors that the IRS looks at, but if they come in and they determine that a person you said was an independent contractor is an employee, you're going to be assessed a lot of penalties and other things because you did not pay in as you were supposed to. And not only that, the person who is considered the independent contractor, it's like they're a sole proprietor. They're responsible for all these extra things. If they weren't aware of them, they get a big shock when they go to do their taxes. So that's all I have to say about that. So I didn't get to my first tax credits, but I think we'll still be okay, even if we have to wrap it up next week, if we don't get through all of them on Thursday. But that's where we're going to start. Talk about some tax credits. We've got about 5 or 6 of them. that we're really going to focus on and make sure you understand. There's more than that, but we're going to talk about the normal ones, the ones you'll see the most. Okay, so that's all I have for today, all those additional taxes, and that's quite enough, right? Do you guys have any questions for me? Okay, well then I'm going to let you go enjoy the rest of your evening, and I will see you on Thursday.